Earlier this week, I added a new position to my portfolio that currently yields over 9%, pays monthly dividends, and exposes me to an asset class I haven't previously held any investments in. My newest holding is in the Pffa US Preferred Stock ETF, ticker PFFA, which is a fund that holds preferred shares of companies and also uses a small amount of leverage to boost its returns and income. In my opinion, preferred stocks are some of the most ideal holdings for people who are either retired or just want a steady dividend. So in this video, I'm going to go into detail as to why I expanded my portfolio into preferreds and why I chose this ETF out of all the others that exist, and also where I think this investment will go in the future. The Pffa Preferred Stock ETF has a pretty straightforward description. According to its website, the fund seeks current income and, secondarily, capital appreciation through a portfolio of preferred securities issued by US companies with a market capitalization of over $100 million. According to its fact sheet, this ETF has three key features, which are a focus on income, active management, and enhanced exposure through using a modest amount of leverage to help enhance portfolio beta and current income. PFFA is a relatively new preferred stock ETF, having launched in 2018, about a year and a half before the pandemic and subsequent interest rate hikes. As of the making of this video, there's around 20 preferred stock ETFs out there that exist, and PFFA is right around the middle in terms of assets under management. I'll start with a brief introduction to preferred stocks if you're not too familiar with them. Fundamentally speaking, preferred stocks represent a share of ownership in a company, just like common stocks do. But preferred stocks are pretty significantly different from common stocks for a few reasons, and they actually are pretty ideal investments for income investors. You might be familiar with the following ticker symbols. These are all common shares of companies, and ownership of them gives you the potential to experience gains when the company flourishes, such as share price growth and dividends. They also give you the right to vote for board members and other corporate events. But some companies will also issue preferred shares of stock, which is just another way for a company to raise capital. It's often said that preferred stocks are pretty similar to bonds, which I think is pretty accurate. These investments almost always come with a guaranteed fixed dividend payment unless the company is in significant financial distress, like bankruptcy. If we take a look at shareholder priority, you can see that shareholders of preferred stock actually have a higher priority when it comes to both liquidation of assets as well as dividends. Before common shareholders can receive any dividend payments, preferred shareholders must be paid dividends first, as the name suggests. Also, if the company were to go bankrupt, then preferred shareholders are entitled to the company's assets before common shareholders if there happens to be anything left. Another difference is that preferred shareholders don't get voting rights like common shareholders do if that's something that happens to be important to you. If you look at an example of a preferred stock, such as AG&CO, you'll see its share price has remained relatively stable, with a few dips here and there, such as with the interest rate hikes and the pandemic. This is because practically all preferred stocks trade at their par value. It also has a very steady, high-paying dividend yield. So overall, preferred stocks are pretty good investments for people who are seeking income. But the reason why I always recommend people invest in a preferred stock ETF or closed-end fund is because most individual preferred stocks themselves don't have very high trading volumes. If you want to build up a large position, you might run the risk of not being able to sell all of your shares if you need to. At least not right away. This is called liquidity risk, and the reason it happens with preferred stocks is because they usually aren't that popular of investments. Most investors prefer the common shares of a company because they can potentially see share price growth and their dividends increase, whereas preferred shares are mostly fixed in these areas. At the same time though, these exact same companies can also go through dividend cuts and massive share price declines, as we've seen with many companies that have preferred shares. This ETF is my first investment in preferred shares, and I've said in the past, again, that if you do want to hold these kinds of investments, it's best to do so with an ETF or a closed-end fund. So what exactly makes PFFA different from the alternatives that exist, such as the iShares Preferred and Income Securities ETF or the Invesco Preferred ETF? While these other funds are worthy considerations for people interested in income, what I like about PFFA is its investing strategy. There's more going on with this ETF than just holding a collection of preferred stocks, which is what most of the other funds do. For one thing, PFFA has been able to provide a much steadier and consistent dividend. If you take a look at the Invesco ETF, you'll see it pays a different dividend every month. The same is true with the iShares Preferred ETF. In fact, this is how all the other major preferred ETFs work, whereas PFFA is a lot more predictable. The company lays out their investment process on their website. It says, Step 1. Evaluate potential investments on a variety of key variables, including the competitive position of a company, the perceived ability of the company to earn a high return on capital, the historical and projected stability and reliability of the profits of the company, the anticipated ability of the company to generate cash in excess of its growth needs, and the access of the company to additional capital. What's important to keep in mind is that PFFA is not an index fund, it's an actively managed fund by a group of people who use their own process of picking stocks to go into it. I also think it's worth mentioning that their standard of what can go into their fund is a little looser than other preferred ETFs. The only requirement they seem to have is that the market capitalization of the company must be at least $100 million. The indexes used by other funds typically have more requirements than this. The unfortunate downside to an actively managed ETF is that it almost always comes with a higher expense ratio, which is true for PFFA. This ETF's expense ratio is pretty high at 2.52%, which is undeniably high for even an actively managed ETF. But as I like to say, there's two things to keep in mind with expense ratios. First, the distributions are net of the expense ratio. Some people are under the impression that the expense is subtracted from the dividend payments, like the stated dividend amount will ultimately be lower because the expenses are taken out, but that's not true. Second, I always like to say that if an investment functions in a way that fits your goals and your own preferences, then there's nothing wrong with paying more. If an ETF or a closed-end fund can pay me consistent high monthly dividends, then I'd argue that as an income investor it'd be worth it. But ultimately though, it's all a matter of personal preference. Step 2 for this fund is to generally underweight or eliminate callable preferred securities exhibiting a low or negative yield-to-call ratio. The yield-to-call ratio refers to the return a preferred shareholder receives if the shares are held until the call date, which occurs sometime before it reaches maturity. Some preferred shares of stock are callable, meaning that they can be taken off the market before reaching their maturity date. If a preferred stock has a low to negative YTC ratio, it means it's estimated that they'll earn a lower return on these positions. As a result, the management team will adjust their portfolio to either eliminate the holding or reduce their exposure to it. Step 3 is to apply leverage to potentially enhance portfolio exposure. Leverage does make this a more riskier investment than other preferred ETFs because leverage can either magnify gains when times are good or increase losses when times are bad. Because preferred stocks are similar to bonds, they're often priced very similarly. Due to interest rates being high, it's resulted in most preferred shares of stocks currently being undervalued. When interest rates finally do start getting cut, then preferred shares should increase in value. We could still be a ways away from actually seeing interest rate cuts, so this makes preferred investments more attractive right now. The final step is employing options overlay strategies that primarily seek to provide additional current income. This is how PFFA is able to provide a much higher yield, which is currently the highest yielding among all preferred ETFs. As of the making of this video, PFFA currently holds 185 positions in its portfolio, with their top 10 holdings making up about 30% of its portfolio. It's quite a bit less than the larger preferred ETFs, like this one from iShares, which has over 400 holdings. So that's going to be another thing to consider. PFFA is a fund that takes lower risk holdings and adds some more risk to provide a higher dividend yield. People have also wondered what the tax treatment of the dividends are. And ultimately, it's going to be a mixture of qualified, non-qualified, and return of capital. It really depends on the tax treatment of each company that's inside of this ETF. So in summary, PFFA in my opinion is one of the best ways to invest in preferred stocks. These investments come with dividends that are of a higher priority than their common stock counterparts. PFFA has a much more stable share price that doesn't move too much during any trading day. It pays monthly dividends and offers an excellent dividend yield. It may not offer much potential in share price or dividend growth, but PFFA is a good holding for people who want a good monthly dividend for retirement or want to see their dividend snowball work its magic. Let me know your thoughts on PFFA and if you hold any shares for yourself or shares of any other preferred ETF. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.